to George and Bruno. Very nice conference. I'm so happy, and I actually surprised. My over-under how many people are here at 6 p.m. or the second day of the conference was 5. So I'm surprised.
It's the party from yesterday.
Yeah, exactly. So, quant factor invest in emerging markets. How we can take possibly advantage for a long volatility strategy. So what everybody knows is there have been an increase of quantitative investing techniques since GFC. By the way, in China, they call it the Western financial crisis, not the global financial crisis. And however, the majority of factor investing techniques are not new. FAMA French model, 1970s, is very old. It's very little things are actually new. Since 2015, with the deep learning bubble, there are basically also increase of hype about artificial intelligence or big data. But too frequently are actually a marketing gimmick. So actually in practice, most of AI funds have something very comparable to what we call it quantitative long-short equity before AI was, where we were also in the winter of the AI, so nobody was saying we're using neural networks. So it's not really new. And people say, actually there is rent-tech capital. Well, rent-tech capital is the exception, it's not the rule. And the main advantage is they've been forced. They collecting data since the 1970s. So it's not fair to compare to them. And secondly, they don't have any clients, so can take very high leverage. And actually the unlevered return is probably low, even if are very secretive. What we actually know, what is the real change, is the change in IOM, asset under management, of strategy they basically use as a historical volatility as a main input for risk taking. What I mean with that is, if you take volatility and you measure, and it's outside your model you don't know nothing about, that's completely different to use it as main input to say how much money I'm gonna bet on that particular signal. Because the volatility is low, I'm gonna increase my bet. So there may be some information that we can use to build a trading strategy. And just to give an idea of the size, it's very difficult to quantify exactly how much money are in quantitative strategy. Call say 2 trillion, and Financial Times saying 1 trillion, but you can see also from prime broking data, there'll be increasing allocation to quant fund. And especially all the portfolio, they say we do quant factor investing, are normally have packaged as some volatility control or volatility target mandate. What else we know in the literature? So if you do a multi-factor market neutral strategy, you need to borrow securities. And borrow security means you can leave possible information in terms of footprints, because you need to go to a prime broker typically and ask for a borrow, and so you have borrow utilization go down, so you have some information that can potentially be useful. And this will have been used in the literature before. There is kind of answer, there's seminal paper I think in the area, but you don't see uses some comment about emerging market, but actually we hypothesize that actually the impact of finance or lending data can be higher, because in emerging market is higher margin, higher spread, and the capacity is lower. If you get exhausted, it can be possibly crowded a lot. The crowding problem can be magnified. However, what is crowding? Crowding is very perplexing context. So people say, can be sentiment, people get too excited about something, so they're crowding in. Yeah, makes sense, but very difficult to put in good mathematics, I would say. Ansner's market making, and Bruno recently saying portfolio construction. However, actually, if you financial media, especially, they always find post of fact after let's say a stock went down. Oh, actually, that went down because it was crowded. I don't know if you follow Valiant or Bill Ackman cars, but one example that everybody was speaking very well about Valiant until it went down and say, oh, everybody was crowding the stock, but after the fact. The reality is actually that crowding is a not linear problem. So if you are in a crowded trade, most of the time you're actually in a good direction, because you can call it a wisdom of crowd and say, okay, everybody crowd this strategy because it's a good way to do. The problem is fire sale, so when everybody want to get out at the same time, so there is no bid. And which happen rarely, but can basically, if you run a fund, you can basically close down, simply because you need to meet your margin. So this, I apologize, there is too much information, but unfortunately, real life is hard. So what we know about the problem in a schematic way, we know the quant fund increased recently AUM. So factor get passive allocation. Passive allocation means they drive order flow, and factor tend to perform well if all the people buy the same factor. So, and one of the first examples was Two Sigma. They basically, for a relatively small fund of some $1 billion in 2014, it basically made 50% in 2015. And everybody, quattro factor investing is the thing now. So you have a constant, if you have a constant passive flow, it can lead, not always, but to low volatility realized for crowded security. Is the best way to say, if you have somebody always buy the dip, you basically have the volatility keep to stay low. So low volatility, if the volatility go down for IMPA for risk taking, you may think, okay, we can leverage more. So you have too many dollars that tend to enter this factor security, and security, this more academic term, I say trade away from fundamental value. And at some point, there is, in this theocratic event, there is increasing volatility. This is unpredictable. Can be whatever, can be a Trump tweet, can be an earthquake, or can be simply a portfolio manager, the risk in his portfolio because go on holiday. For example, in my small, I don't move the market, but I'm here in Brazil, I sell some assets in my portfolio to have less risk. Not because my model tells me to do so, but because I'm going on holiday. So if you have a completely unpredictable event, they can say, oh, volatility go up, I need to take down risk. So shorter term strategy need to rebalance. And this, in the current market microstructure, there is predatory HFT that are not bad people, but are not charity, so it's their job to predict flow and take take a view of where actually the stock go, can lead to exacerbated mean reversion, and longer term strategy need to rebalance as well. So you basically have a whole strategy need to rebalance at the same time. You tend this negative skew in this particular stock that are crowded. So possibly, if we can identify this crowded stock that we assume that have a low volatility, lower realized volatility given the flow, we may be able to build a spread between what we define crowded stock and the market and make a living, possibly. Anyway, we use short data. So basically, brokers send data daily about the availability of security or data as a utilization. And, but however, are very, very noisy and very low quality data if you compare to other fields like speech recognition or image recognition. You have billions of examples of what is a dog, what is a cat. It's very not linear. You need the neural nets that are able to compute very not linear relationship to recognize with a cat or dog, but you have a lot of data where you can fit your model. In finance, it's not the case. The difference that if you probably work in the field, you should have at least some knowledge about the dynamics, especially in a mid-frequency strategy, that cannot, a lot of time, be played from data. This is exactly where the Bayesian framework can help. So this is normally a slide I do for the machine learning community, because if you go to a machine learning conference, they're all interested in fitting a maximization model. Actually, what I do in daily day, one of the most important things when you try to build a new strategy is scope the problem and gather what you know about the problem, what you think you know. And formulate a generative model, possibly add structure, and use at first, that is very important, to use just partial the data, because as soon as you use all the data that you use for auto sample prediction, you're gonna completely bias your further result if you keep using this data. And so you have a test set basically overfitting. And when you think you have some reasonable model, we call it good enough, you can basically then do the fit and the maximization, but it's actually really small part to do the fitting and maximization to find the best strategy, that instead if you go a software engineer in the Silicon Valley, I think is all what is quantitative finance is. So to schematize, this is still a pictorial representation, but what I told you before is you can, what is the, yeah, so you can see that this is a stock that getting crowded, so a positive return over the mean, and you can the only thing important in this picture is the slope. So it tend to have a self-reinforcement low volatility outperformance low, tend to be an unpredictable theoretical topping that people care about, but it's impossible to predict by definition. But actually, when the market come back to the mean, for the fact it's crowded and there is fire sale, tend possibly to be go down more faster than before. So what you care about is the difference in the slope. Okay, add a good enough structure. We don't have again, cat and dogs, picture when a stock is crowded. Yes, you have some brokers and data vendors that have their own definition. They don't tend very good, in my opinion. And later we're interested to find the perfect definition of crowding. That is not what you are out. What you want is to basically add a reasonable structure that help us to filter out some noise and to help a machine learning model to learn from data a possible definition of a classification of crowding. And so, for example, here the transition probability is all pictorial. We don't know what are the transition probability. We just define different class that seems reasonable. There are stocks that are unpopular, that don't trade often, especially in emerging market. Stock that are outliers, there may be an event. And stock that this is the market, like some stock underperform and overperform, this is by definition. And there is just a small class that is we possibly define crowdness. Again, this is probably not the best structure to do it, but important to help to build guide a machine learning model to label the data. And we also undertake another trick. We can't really use skewness in very short, the classic definition of skewness, because being the third moment is not very robust statistic, so it's very sensitive to outlier. So you're looking for other proxy of skewness, let's say. So back in 2004, introduced the timing ratio, like Bloomberg called beta plus and beta minus. It's simply a ratio. They tell you if a stock compared to an index, in this case is the ETF, that if the market goes up, your stock go up more than the market. When the market go down, your stock go less down than the market. So positive is actually a good, in theory, is a good feature. The problem that if you divide beta plus, beta minus, you obtain discount distribution. This is all over the stock. So we very, 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 very fat tail, because a stock can have a beta very near zero, so it go to infinity or minus 50 according to the numerator or denominator. So you need to basically try to normalize this data to have a reasonable level where you actually think is comparable. In finance, the problem is a lot of time there is no clear definition what is the right objective function is. Try to maximize return is normally a vain quest. You normally very simple machine learning model in the last 10 years almost always try to learn just momentum, that is already well known in finance from 30 years, and low beta anomaly, that again is well known. What you're interested to train the model is about, this is a timing ratio for a stock. So here you can see there is outperformance in timing ratio fashion in this stock. What are you interested in when the slope is high? So this very steep slope tend to be correlated for future positive change in volatility. That will be our definition of crowdness. That again, we don't want to explain to you this is the best way to describe it. We just say is useful in our prediction model. So another important step that actually is De Prado, that just published a recent book that record a lot of success, and it was actually just recently IOAQR, probably on the back of the book. argue that utility of meta-labeling for purposes of supervised classification model. So to add let's say, more stupid, more high-level algorithm, but able to filter some noise. So our meta-labeling is help us to basically have a high filter that a human trader will probably have. For example, this is a stock. This is post-date. It's very easy to say this was a pump and dump scheme, but this stock made 30,000% in a couple of months. So it won't completely up. And so if you feed a normal machine learning model, it's gonna learn, you should buy the stock here and nothing else. So the first fitting I did on the data, this was explaining 95% of all the P&L of the strategy. So you need to have a way to basically filter this kind of noise. And you've seen a lot in the literature that make me mad. You see, okay, let's just exclude the stock altogether. The problem that is hindsight bias. You cannot do that. So you can build some very not super sophisticated model. This is just based on k-means, but you can use other clustering techniques, to be honest, just based on equity free float, turnover, and cumulative turns exchange points. We basically said in some area, this looks completely off of what other stock in the market are right now. So we can possibly classify in a different way. So we can feed this information to a more sophisticated model. They actually do the training. But you need to explain to a model that this is not signal, this is noise. And as a trader, you will don't know the first day, but at some point you will know that this stock is not good for a quant factor spread interest rate strategy. So how we learn crowding, this meta-labeling step just filters some noise, doesn't give any accuracy on future data. What we use a random forest methodology only on pre-processed and landing data factor data. We don't use any price of fitting. Otherwise, you're going to learn momentum, you're going to learn low beta. You're not going to learn your data interaction. You're going to learn interaction with the price. This is just to give an idea of the fit. This is not important because you actually use a random forest is based on the average of random fit that is help to basically with multicollinearity problem. What is actually interesting is see how we make this prediction, which variable important. So we saw value on loan trend. So if there is change of supply and demand of security, this tend to be important to make our prediction, or utilization that actually we expected is very well known in the literature. And use factor data from Bloomberg that BQuant, there's a new product, they basically help us to fit this model. It's not as expected, no one of them is very predictive, but give an idea of, say, if, for example, momentum stock becoming very interested in very surging lending data. So other things for a variable explanatory power is very reassuring because we basically, what all these tell you, we can make prediction just if the utilization is high. If we could make good prediction with utilization with low, we'll probably be very suspect there was something bad in the model because we would just lending data to make our prediction. So if the lending data are general collateral, it will probably not be a good one. Anyway, this is the outcome. So this is the theoretical volatility spread. If you buy volatility, theoretically, on what the stock you classify crowded versus no crowded stock. So are basically we define as a market. So over 3-year spread, you have around 5,000 entry points. And it's good to see that we identify over universe of 400 stock around half. At some point are classified crowded, so you're not have just 5 old stock that drive you all the spread performance. So here you have a 10 volt point that if you trade in a normal 100K Vega, it will be $1 million, something like this. So you have a significant T-stat. But again, this is very, very theoretical. A positive volatility spread doesn't mean that we can monetize the strategy. In theory, you have variance swap. They offer a straightforward and direct exposure to volatility underlying. However, the trading in the emerging market doesn't really happen. You can do some dispersion trade on EM, ETF, but not much else. And the vanilla option as well for our universe is not tractable. In Hong Kong is around 30 names trade vol. And the alternative way you can do is basically have a synthetic replication, as we know, and you can build a spread between the shorter realized variance and longer realized variance. So for a stock level large crowded, we need to go short daily and buy the weekly vol, and vice versa for the other. And you want to implement this strategy vega neutral because you don't have any idea of the direction of the implied volatility in general. You just want to know the spread. So how we can access to relatively long-short exposure by synthetic replication. And in academic literature, it is normally referred Carl, I see refer a lot. In actually here, we simplify things, and we use a Deutsche Bank methodology that reduces the implementation to trading the net of stealth in delta, so daily versus weekly or bi-weekly. So the implication is very imperfect. But because we miss, the things is very missing is the jumps. We completely missing the jumps. So if our data is biased, favorite or negative of the jumps, we'll have a problem. But actually seems to be reasonable on the data, the assumption of almost stochastic error of the jumps. So sometimes you get lucky, sometimes you get unlucky, but on 5,000 trades tend to wash out. And given the signal is clustering, so someday we define 5 stocks are crowded, other they are 0, other they are 35. You need to basically do a lot of portfolio optimization to see how you actually create a tradable strategy, and the cost actually is very low. You can be Hong Kong stock trade 2 bips. The things is, in reality, you want to put together other trading system that you have that, of course, in my case, are under IP of the company. So you want to see how this signal, if it's orthogonal to other things you already trade. Otherwise, it's not really useful. Sure. Yeah, I just finish up. This is a link actually for Julia presentation. So crowding is often associated with the investor overconfidence. Yes, makes sense. And in particular, there is overestimation of investor own signal precision compared to competition. Everybody thinks to be smarter than the other guy. Otherwise, we'll be not in this business. But it's impossible that everybody is smarter than competition. And also, well studied, as Julia said, confirmation and insight bias are very resonate with our finding of possible crowding. But what I want to put in the art here is the given current dynamic of hedge fund, there is so much pressure on fee and monthly performance. We argue that also relevant and consistency in bias generate crowding. Institutional investors like very much story and recent performance in their investor allocation. So if you're an hedge fund manager and you raise money on, let's say, on tech because NVIDIA is a good company, it's very hard for you, even if you have updating your belief that NVIDIA is not a good company. Because if you actually had a good earnings a couple of weeks ago, you would have you will be consistent to your investor and to yourself that you went in 1 month for the show to say NVIDIA is the best company in the world. So it creates a lot of dynamics for the fact that now there is a lot of drawback to our hedge fund, at least in my perspective. So in conclusion, machine learning is not magic, this I always said, because related to the current hype, more in other kind of conference, there is so much hype and have an unrealistic expectation of what you can do with data. And there is some value in the stock factor data, however, it's not easy task to take it off. Bayesian framework can help to build good enough signal, not to fit the data, but to maybe have something that is better than random, that is the only thing you care about. And to have a signal and monetizable strategy, absolutely is not the same thing. There is a lot of work you need to do. And you need to have actually around 10, 15 signals to make a realistic portfolio on top of a risk system in order to exploit this characteristic. By itself is not very viable. And yes, any question?
Questions? Yeah, but I was wondering, you know, I was trying to relate your talk to my talk and those transition. So first question, when you talk about transition probabilities exactly here, are you talking of through time, or are you talking the probability of that some asset class will spill over to other asset classes?
I just mean that when you train a random forest, in this case by any other algorithm, you show them example of what happened in the past.
Yes.
And in order to make the prediction of tomorrow, use your prediction of yesterday. So automatically, when you do the fitting, is learning there is a transition probability. And for example, if a stock is outlier, you don't want to predict outlier, crowded, outlier.
Okay.
It puts some stability in the system.
Okay.
Again,
That's what I understood. Okay, well, okay, very good. And well, I mean, the rest I really would like to, because I need to go through your presentation very much in detail, and because there's a lot of meat in it.
Yeah, I'm sorry. It's like, real world is hard. Real trading is hard. Any other question?
Okay, any other?
Did you write the text, or you just have the slides, or?
At the moment, the slide, of course, there is. I'm using internal data, so the broker sent me the data, and enough. Northwest, kinda, I can use it, but it's a bit of gray area. I merge a lot of Bloomberg data, I merge other data I get. So there is a lot of database collage going on behind this that is very hard to publish exactly like this. I will try to publish a spillover or another kind of paper. Yeah, the slides are available. Yeah.
Okay, any other question? So let's thank